Hi, Chris Duff over at Serious Land Capital, vacant land funding partner. Today, I just wanted to remark on how we would typically approach seller financing offers. So within our funding business, the cash turnover is really the most important piece. If we got stuck in a whole bunch of seller finance deals, yes, the cash flow that we can generate from routine seller finance sales, yeah, that could become significant, but then our acquisitions naturally would get impacted because we're just not going to routinely have as much cash on hand. So we'd either have to inject more equity into the business or slow down operations until enough cash flow is generated from other finance sales, or just have like a mix of enough of them. But um it can also impact the kind of direct calculation of certain vintages that we're putting together within the business. So just to break down that piece, I have two other equal equity partners within the business, and the way we generally operate is, roughly each year we will be acquiring and then selling assets within the business. And there will be certain hurdles for performance from a profit perspective. And then the kind of final profits are divvied up depending on the, again, overall hurdles that we're hitting from a profit side. And I can get into more of that later, the way we strategize on how to do that. But because we need all funds in for a particular sale of a property, that means if we did a seller finance sale and didn't try to sell the note, we wouldn't able to close out that vintage because there's still outstanding revenue that is expected for that particular property, so we can't fully close it out. So that's a whole nother discussion there, but just to give you an idea on why we try to turn around cash on deals as much as possible, whether we're taking an initial cash or seller finance offer from a potential buyer from or for our various assets within our portfolio. I think a lot of other funders operate similarly, especially those doing equity funding. I know some might try to set up separate funds where they can buy off the cash flowing seller finance note. That's interesting strategies, not something that we've set up fully on our own. It requires a whole another bunch of funds as well, and you have to be able to feed that routinely. So if you're not doing that many seller finance sales, it doesn't come into play as much. And on average, I mean, we typically offer owner financing for most properties that we have listed. It's generally not our preference to go down that route. And I'd say that most offers don't approach us for that anyway. I mean, we tend to go after higher priced properties. Our preferred purchase price is above 50,000. And a number of properties we purchase are above 100,000. So, there just haven't been as routine of kind of buyers within that pool offering or, making an offer with owner financing in mind, or they'll try to get a third party lender involved, which is fine for us. Sometimes they can be a pain from a title company closing perspective, but, at least we get paid from, upfront with another third party lender involved there. I know some other land operators will have different experiences there, but I can only remark in terms of the type of offers that we tend to get. Plus, we primarily list on MLS, land.com, and that might impact the type of end buyers that you might get interested within your various properties. So, even though we offer it, if we do get some interest from an owner finance perspective, again, I'm always going to want to reverse engineer my anticipated table close of selling the note, or, selling the note within, roughly 3 months of seasoning will be generally what we'll target on the high end there. So if you can set up the note properly for anticipated note buyer, and so we keep a couple on hand that we kind of know what terms they'll look like or look for. A friend of ours, Eric Traga, I know he's well known within the land investing space. He routinely buys notes, and so and is a very savvy operator, has a good mind for numbers. So, I try to look for reliability from these type of folks. And, usually he'll want, at least from my understanding, a more recent conversation, rarely would want to go beyond like 150K in terms of a overall note purchase. But, around that threshold or below, we could potentially get paid 80 cents on the dollar of the, price that our buyer is paying, sticker price for an owner finance perspective. And then just understanding, Eric's terms, for instance, and, some other note buyers might look for similar things of, maybe 20 to 30% down, max 8-year term, 10.9% interest at a minimum with credit check and a personal guarantee. Even if we were doing a note, I'd probably do something similar. I'd probably even want to try to cut the years down even more if I could, but and probably bump the interest up a little bit more, just because the hurdle rate for inflation plus monetary debasement of US dollars, that roughly equals 11% per year anyway. So you're basically just breaking even on interest even that high. So to me, I would try to get a bit more premium if I'm going to be taking risk from a lender position anyway. But, that's kind of baseline numbers. So then I'll know anytime an agent might bring us, hey, somebody's asked about owner financing terms, I have that on hand, and I can have much greater reliability for if this person, makes an offer here, that I'll already have a table closed note buyer ready to go that's going to offload that note, and we can, have a very kind of conservative estimate for the quality of that potential buyer. You could take different approaches to, come up with your own terms. Maybe you can scout across paper stacks, see what's moving more routinely, or maybe other note buyers that might look for different type of terms. But, the actual terms don't matter in so much themselves, so long as you do know how you could exit that particular note. What's way riskier is you just come up with whatever terms on your own, sign all the docs, basically close the owner finance deal, and then start looking for a note buyer. I mean, if you've done it before and done it successfully, great, go for it. Otherwise, it's going to be more conservative if you can just reverse engineer the terms for what other note buyers are looking for. So that's generally how we'll approach it. And, if we can't get, a firm confirmation from a note buyer, we'll just back out of the deal. Like, I'm not going to take the risk, or, then maybe I have to get on paper stack. Who knows how long some of those could sit, or maybe it just screwed up the terms, the asset for whatever reason wasn't that attractive for other, individuals who might be looking for these type of notes. So that's just something else that I'd want to keep in mind there. And even with all of that in mind, we haven't actually gone down that path to table close or even sell off a note. Like, ultimately, all the other properties that we cash offer or a third party finance offers ultimately come into play. Like, we've definitely entertained similar financing. It just, even when we offer it, they don't tend to be as routine for the typical assets that we're selling and the buyer pools that seem to be looking at our properties. There could be other avenues. You can build more velocity. I know some people do seller finance all day, every day, and have a lot of success with it. It hasn't really been a core feature of our business thus far. That might change, but I want to give you an idea on how we approach things so we can still understand what our anticipated exit is. And that's the thing too, is if you're going to take a seller finance offer, again, ensure that you're looking at like an 80% cash on cash return from whatever that sticker price is that the buyer's going to take. That's why usually you'll want to build in a bit of a premium for accepting an owner finance offer, because keep in mind too, if an agent's involved, you're going to need to pay the commission on that sticker price plus closing costs on that sticker price, not on that 80% exit that you're anticipating post discount from a note buyer. So you're percentage, closing costs are actually going to be higher relatively compared to, if you just close cash at that number. So you'll want to bake in a bit of buffer when that is in mind. And same thing too, if you were to, not even try to sell a note off to a note buyer, is that, you'd have to pay all that commission and everything up front, out of that down payment that you're getting. All of a sudden you can be getting way less in the door, assuming an agent assisted with bringing that offer to the table in the first place. So a whole bunch of considerations. Hopefully this one was helpful today. SeriousLand.capital for any of your funding needs within the land space. Zero cost diligence at Land Daily Diligence Facebook group, and landpricer.ai for the most simple and accurate way to price land. Take care, everybody. Bye.